What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me tonight. It's actually Christmas Eve. I just got done wrapping a bunch of presents for the kids. Um, so, Merry Christmas to those of you out there who celebrate. I appreciate you being here with me. I wanted to make sure that I dropped you a little Christmas gift here on the channel. All right. Now, this video is primarily going to be about the subject of higher highs and lower lows on the inside. All right. I know that a lot of traders get confused about this, but in my opinion, it's a lot like everything else. Okay. It's easy to overthink, it's easy to overanalyze, and it's easy to overcomplicate. All right. So we want to keep this very simple. And I want to explain to you not just how to, maybe identify these things, but why are we identifying this? What is the significance of the higher high on the inside or the lower low on the inside? Why are we looking for this? Okay. So that's what this is primarily going to be about, even though we're going to touch on a few other things. All right. Now, with these videos are meant to be pretty basic, not very advanced, all right? We're not going to be talking about entries at all. We don't need to talk about entries, okay? So going through this video, I want you to keep this in mind. This is not about reading candles or anything like that. Instead, think about this from a structural standpoint, all right? We're looking at structure. We're looking at templates, okay? We're looking at the overall shape or profile, the outline of the market, all right? Just so we can lock this into our brain, because at the end of the day, the market only does three things, all right? The market only moves in a certain way. You know what I mean? And that's what I'm trying to draw your attention to. After we go through these slides, depending on how much time has passed, we may just open up Trading View here on the phone and look at a few pairs so we can look at some live time examples, or rather, some chart examples, so you can see with candlesticks and all of that, how this is all going to work, okay? Now here, this first slide, you can see we're talking about the close and breakout signal. We're going to touch on this briefly, all right? And also talk about these lower lows, higher highs on the inside, all right? Now, the close and breakout signal day can offer either or a continuation or reversal the next day on the trade day, okay? No matter the signal, however, we still need to inspect and respect the timings, levels, and behavior of price on the day, all right? Now, what will really give this away is the lower low or the higher high on the inside, all right? And what I mean by that is, what direction does the market want to trade in today in your session, okay? What's going to give that away is the lower low or the higher high on the inside. Now, you hear Stacy say this all the time, and I'm going to repeat it here. The lower low on the inside is the setup for the pump and dump. The higher high on the inside is the setup for the dump and pump, all right? Now, in this example here, let's take a look at this. We have our previous day's low marked off, all right? So you can see this market has put in a high of the day level, locked that in place, and then traded straight down through the previous day's low and has closed in breakout, okay? So the previous day put in a low at this level. So when we close in breakout, we put in a new lower low, right? Once that lower low has been put in place, the market starts to pump up, all right? This lower low here, right here, this is an external lower low, okay? So it's not a lower low on the inside, but it is a lower low, okay? And lower lows, just like the lower low on the inside, lower lows in general is the setup for the pump and dump. This lower low becomes the anchor of our pump and dump, okay? Or the target, okay? Because if we are in the process of putting in lower lows, all right, this low is going to be taken out on the way down. If this is our high, right? Let's say the market is making lower lows, lower highs, lower lows, lower highs. It's trending downwards, okay? Here's our swing high. Here is our strong high that should not be broken as we continue to put in lower lows, okay? But this low that we've put in place is a weak low because it should be taken out. It should be broken when we go to put in the next lower low. Okay. So this lower low is put in place. We pump back up into the previous day's range, trading back into, but not through that high from the previous day. All right. And then the market gives this little gift, this lower low on the inside, right? We call it a lower low on the inside because it is inside the current day's high and low range, okay? It's inside of the previous day's high and low range. It's a lower low on the inside. Now, if we took away this first day and we only look at this day, right? Then you see we have put in this lower low here. Then the market is pumping up. While it's pumping up, the market is in a smaller time frame uptrend, okay? It's putting in a series of higher highs and higher lows on the way up, okay? On the way up, these lows remain intact, meaning the market does not come down and break these lows, okay? It does not do that until here in the London session when this market drops or dumps quickly, right? And puts in a lower low. It's a lower low on the inside because it's breaking structure to the left, right? We have these lows here, we have these lows here, but when this low is put in place, it breaks structure on the day to the left, all right? So just like the same way down here, we put in this lower low and then start to pump up. Right here, we put in this lower low and start to pump up. This lower low becomes a target, right? We might be aiming to take that out. That becomes the anchor point to the pump, coil, and dump, okay? We're building the house. To build the house, we first have to put in a wall, right? Then a roof, and then another wall. Same thing that's happening on the day, right? Putting up a wall, a roof, and then a wall. We're building the house, okay? And for those of you who pay attention to the previous videos, you will see that the master pattern is in full effect here, right? Because we have a peak formation low, a peak formation high, lower lows on the inside for the pump and dump, okay? To complete that master pattern template. This, that the master pattern template is so important, all right? Whether you're looking for a 3-session setup, you're looking for a 3-hour setup, a 3-day setup, that master pattern template can really help you out. All right. Now, while this market is making on the day higher highs and higher lows, okay, we're on the front side of that move. So if we were to use our little visual aid trend line, right, and just mark off through here, we would see that this lower low on the inside that broke that structure could be signifying to us that we are looking at a potential shift from front side to back side. Okay, here's the front side of this move. Here's the back side of this move. We are alerted to this from the lower low on the inside. Okay, so that is sort of how and why we are identifying or looking for lower lows or higher highs, whether they're on the inside or not. Okay, let's go to our next slide here. So what I'm showing you is the only 2 options for the close and breakout, okay? The only things that I want to see when we have a close and breakout. So you can see here, the very first sentence on this slide, the close and breakout signal day can offer either a continuation or a reversal the next day. So all I want you to do is imagine, okay? Here's our close and breakout. Let's say that this market closed and breakout to the upside, okay? So the market broke out of the previous day's high somewhere around here, continued to go higher, and then closed up high, closing in breakout, okay? This market opens the next day, Tokyo puts in a high and then starts to trade lower down to London. Again, you'll recognize the master pattern, right? Peak formation high, peak formation low, higher highs, okay, for the dump and pump in the New York session, all right? Now, again, if we have these lower lows, lower highs, this is sort of like our front side of the move. This higher high on the inside is alerting us to a potential shift from front side to back side. Now that we've started to put in higher highs, we are on the back side of this move. Now, again, here we have traded higher, closed in breakout. This market dumps down to continue to go higher. This market trades below the previous day's closing price, back into the previous day's range before giving a reversal signal and then going parabolic for the long trade. All right. Now imagine the opposite scenario. Imagine we've closed in breakout to the downside. All right. Which, so before, when we close here, this is the continuation type of trade from the close and breakout. Okay. Or this market might break out higher, then pull back to that level, go sideways, and then parabolic for the long trade. All right. But this is the continuation type of template that I'm looking to see. This is the only thing I'm really looking to see after that close and breakout, right? But let's say this market closed to the downside and breakout. So we broke out of the previous day's low somewhere around here, continued to go lower, closed at the extreme, all right? So we closed and break out to the downside, all right? Then this market immediately starts going lower. Bam, we break out of that previous day's low and continue to trade lower, right? Before putting in this W formation, again, front side, back side, putting in higher highs on the inside. This would be an example of the reversal, all right? All of this double bottom here, all of this is right after we break through the previous day's low. The market goes a little bit lower, goes sideways, reverses, all right? So that is the reversal. Same thing would be true here. All right, say this market closed in breakout to the upside. So we broke out of the previous day's high somewhere around here. The market went higher and closed at the extreme. All right. Then you can see here we put in this low, higher high, higher low, higher high, higher low. Okay. So this is the front side of that move on the day. We have broken out of the previous day's close and breakout. Okay. And then, bam, we got lower lows right here. Lower lows going in like right before the New York session. Bam, lower lows. Going into 9:30, we're pumping back up, okay, against that. So this is, again, the front side, now back side of this move once we get those lower lows in place. So this would be a reversal. Okay, we close in breakout, we're up high, we go a little bit higher, throw the reversal pattern, lower lows on the inside, pull back, trade in the timing window, okay, with the timing rotations. Or again, imagine that this market closed in breakout to the downside. So then we have a simple close and breakout, pullback, continuation trade, okay? So this market would close, and these are my favorite types of trades. I like the continuation trades with the close and breakout signal, okay? So the market closes in breakout here. We got our peak formation low in Tokyo, peak formation high in London, lower lows on the inside for the pullback continuation lower, all right? And this is our lower low anchor for this pump and dump. All right. Now here we're looking at the pump and dump master pattern on the day, 3-session setup type of thing. Okay. This market is making higher highs through Tokyo and into the London session. This is the front side of that move. Okay. We have the previous day's low, previous day's high. All right. So there's no level being broken, but London trades back up into the previous day's high. Let's say that yesterday the market put in a lower low. Okay, that's why the previous day's low is down here. There's a lower low, pull back, close. Then this market puts in a low going into Tokyo to trade higher into London. Okay, London trades back into the previous day's high before failing, going lower and putting in our lower low on the inside right at the end of that London timing window. All right, now listen, when I'm saying right at the end of the London timing window, that is not telling you that you should only look for lower lows on the inside at the end of the London timing window, okay? Don't overthink it. Don't make it more complicated. This lower low happens. It could happen in the gap time. It could happen. The point is that it happens, okay? That you see it, we have it happening. All right, again, we're looking at the structure rather than the details, candle by candle, or what specific time we're looking for this. That's not what this is about. We're looking at the structure, so don't overthink it, right? But so this market had previously put in a lower low, all right? We have this low in Tokyo. Now, in London, we have a lower low on the inside, which is the setup for the pump and dump, right? Then this market may pump up into that New York timing window before going a little bit lower, and then right at 9:30 where I have that blue line, or right at 10 o'clock where this blue line is, we get our entry signal, all right? And we start going lower. And you can see this is the master pattern: peak formation low, peak formation high, lower lows, pump and dump. All right. And then if we zoom in just between London and New York, we have a peak formation low, peak formation high, lower lows on the inside, pump and dump. All right. All right. Now here we're looking at, lower lows and stuff like that when it comes to something like a first red day trade. So here, first red day, okay? A textbook first red day should have a pump day, all right? There should be a pump day before the first red day trade, according to the playbook, all right? Followed by a day that takes out the highs and fails, ultimately giving a lower close. So we have our pump day right here. Then this market trades a little higher, taking out those highs before failing and giving a lower close on the day. There's our first red day. All right. Now, when this market pumps up and then fails, taking out the low of the current day, we're putting in a lower low right here. Here's our lower low on the inside. Okay. But it's between days. So we have this day's range that extends into our first red day when we take out those highs, all right? And then when we trade lower right here, this is a lower low on the inside. Then the market pulls back just a little bit and closes, right? Then the next day, this market trades higher through Tokyo, higher into London, right? Before putting in a lower low, pulling back, failing to get back to the high of the day to put in another higher high, right? And then dropping just before the New York window, perhaps, putting in a lower low on the inside on the day, right? For the pump and dump in the session. All right. So the first red day should have a pump day followed by a day that takes out the highs and fails, giving a lower close. All right. This is a pump and dump scenario, meaning if we do not see the pump and dump on the trade day, we do not trade it. Okay. We don't switch our bias and try to go long because, okay, we didn't see it. Now we think it's long. Okay. You don't want to be taking trades that you didn't plan on. Right now, we're looking for the pump and dump in the New York session. Right? The market could be failing and trading lower coming out of the London session. All right. Even though that may be the case, we're still looking for a pump and dump. We should get some sort of pump and dump on a smaller time frame in the New York window. Okay. We're going to maybe put in a low, start pumping up, pump back up into that 20 EMA, start coiling sideways before we engulf or give a pin hammer, right here at the top of this M for our entry. Wait till we break the middle structure of the M, get in there and ride that thing out. Okay. Now here we're looking at examples of higher highs on the inside, right? So here we have the previous day's closing price. So we open up right there, and this market starts making a series of lower lows and lower highs, lower low, lower high, lower low, lower high, lower low. And then suddenly the market puts in a higher high on the inside that is breaking structure to these levels over here, right? This higher high on the inside becomes the anchor point for a dump, coil, and pump parabolic reversal trade on the day, right? So this market could have closed lower, it could have closed higher. Either way, we could be looking for this. This is the higher high on the inside type of thing. Here's our front side as we're in this downtrend, all right? And then backside, once we put in that higher high on the inside, dump, coil, and pump. Here's lower lows on the inside. This is something that I see a lot, all right? And I like to trade these. We have Tokyo, right, that goes up just a little bit. And then let's say that, the market has closed lower, right? Closed lower. Once the Tokyo session opens up, we go a little bit lower, lock in this peak formation low and start pumping back up, all right? Back into the previous day's range. This lower low put in place in Tokyo before we start pumping back up becomes the anchor point for the pump and dump, the target that we're aiming to take out, all right? That pump, if we're gonna get a pump and dump, that pump has to start somewhere. Where that pump starts is from one of these lower lows. And this is why we call it the anchor point. It's where the pump begins, okay? It's where we begin to build that house up. Now here, this is something that I see a lot on the indexes like DJ30, all right? And it looks different to a lot of pairs. These are US indexes, all right? With Forex markets, you're going to see a lot more manipulation on your charts, okay? A lot more volume in the various sessions. But when it comes to US indexes like the DJ30, NAS 100, a lot of days they're going to be basically dead through Tokyo and through London. You're going to have a very narrow range between Tokyo and London, but the market comes to life in the New York session, all right? Now, here you can see this narrow range. We're just chopping back and forth, okay? Then this market dumps down, right? Taking out the previous low of the day, putting in this lower low right here, and then pumping up, right? Now, a lot of days this market will just continue to go, but this lower low may be the anchor point for a very nice pump, coil, and dump. And you can see we get lower lows on the inside right here, okay? Because even though we're on a small time frame, like a 1 minute time frame, we have a 1 minute uptrend, okay? Look, front side, lower lows, backside, okay? Pump and dump, okay? There's a small pump and dump, a large pump and dump where it's fractal or whatever, right? But this is something you'll commonly see on the indexes, right? And this is how and why you're identifying lower lows and higher highs, okay?